The Gambia's domestic debt stock reached $43.8 billion in September of this year, marking a 6.1% increase from $41.3 billion in December of last year. The current domestic debt stock now accounts for 25% of the GDP. This development was reported by the Monetary Policy Committee of the Central Bank of the Gambia. Here is Mariama Dem with more details of this domestic debt rise and how the Gambia is taming inflation and the performance of the dalasi against more muscular, convertible currencies such as the US dollar.
The MPC held its quarterly meeting on November 25 to 26, 2024 to assess the country's economic performance and set the right policies. Briefing reporters at the conference hall of the Central Bank on Tuesday, shortly after the two-day MPC meeting, Central Bank Governor Bua Saidi said short-term government securities accounted for a significant share of the domestic debt. The weighted average Treasury bill rate, he explained, also rose from 10.4% in June 2024 to 11.8% in October 2024.
The stock of domestic debt rose by 6.1% to $43.8 billion, 25% of GDP in September 2024, from $41.3 billion, 28.2% of GDP in December 2023. Short-term government securities with a maturity of 1 year or less.
The CBG governor highlighted the gains made in taming the balance of payment deficit. Governor Saidi reported that preliminary estimate for the first 9 months of 2024 indicated an overall deficit of $12.8 billion, representing 8.9% of GDP, but added that the current account deficit moderated significantly, falling to $59.9 million, which is 2.8% of the GDP, compared to $129.3 million, which is 5.9% of the GDP during the same period in 2023. Governor Saidi further reported that the exchange rate of the dalasi remained stable during this period, highlighting that international reserves stood at $460 million in October 2024, providing 4.6 months import cover.
To September 2024, the dalasi appreciated against the US dollar by 0.3%, the euro by 3.1%, the British pound sterling by 3.3%, and the CFA franc by 1.2%. This was mainly explained by the excess demand pressures to finance the rising imports. The central bank continues to hold comfortable levels of international reserves amounting to $460 million in October 2024, which is sufficient to finance over 4.6 months of prospective imports of goods and services.
The CBG boss also reported that the interbank dalasi market also performed smoothly during the period under consideration, with trading volumes reaching $10.2 billion in September 2024. He also painted a strong liquidity position for the banking sector, which he said showed a strong performance, with its asset base growing to 64.7% of GDP. Total customer deposit, he added, increased by 5.6% on quarter to $66.1 billion. Despite the sector's stability, Governor Saidi said non-performing loans rose to 16.6%, attributed to concentration risks in some banks' loan portfolios. He pointed out that these portfolios were, however, sufficiently provisioned, saying stress tests affirmed the sector's resilience to potential capital and liquidity shocks.
Non-performing loans continue to rise, reaching 16.6% in September 2024 from 10.2% in June 2024. The rise in the NPLs is due to the concentration risk in the loan portfolio of some banks. However, the portfolios are adequately provisioned. Moreover, the bank's latest stress testing results suggests that the banking sector remains resilient to potential capital and liquidity shocks. On the monetary sector developments, annual money supply grew by 14.4% in September 2024 from 6.6% reported in the corresponding period in 2023.
Honorable Sedi also reported that the Gambian economy demonstrated strong activity in the third quarter of 2024, with the central bank's composite index of economic activity showing average growth of 4.9% for the first 9 months of the year. The full-year growth focus, he told reporters, is 5.7%, though risks include global trade fragmentation, geopolitical tensions, and climate-related challenges. The Central Bank's Business Sentiment Survey for 2024 revealed increased optimism, with businesses expecting growth in economic activity and a more stable inflation outlook in the months ahead. The MPC concluded that monetary policy will remain unchanged, emphasizing the need to monitor economic developments closely. The next MPC meeting is scheduled for February 26, 2025. Mariama Dem, reported for Star TV News.